Given the volatility that we've seen in China's stock markets, particularly the Shanghai-based A-shares, it obviously is disconcerting. And the first question that some people might have is, should we buy the dip? Other people might have a different question. Why be involved in this at all? And there's several reasons why you want to be involved. I think the first one is that you're looking at the second largest capital markets in the world. The capitalization of the Chinese equity market is $10 trillion. The capitalization of its bond market is $800 billion, just shy of $1 trillion. So outside of the US, they're the largest capital markets in the world. The second is, it's the only economy that you can find some growth. In fact, I would say it's probably the best 20-year demand story on the planet. As more and more Chinese reach middle class, they'll first start to buy a cell phone. Then they'll buy an automobile. And they get to a point sooner or later where they'll be buying stocks. They'll have excess savings that they need to invest. And we're right at that tipping point right now. And then the third is that just like across Asia, China is in the grips of reform. And this might be the most important reason of all. If savings, as they move into investment, and that investment is high productivity investment, it means earnings will grow very rapidly in China. And that's what's happening. And as I say, it's part of a reform movement that stretches across Asia. There's a reformist in power in India. There's a reformist in power in Japan. There's a reformist in power in China. Now, that might not be pretty. People just disappear. But it's reform nonetheless. And it's very important reform. So if savings ever move from corruption to investment, it might be the biggest investment story you see in your lifetime. One of the biggest negatives people worry about is the level of debt in China, which has grown. There's over $20 trillion of debt. Most of it's in the banking system, which makes people even more concerned about it. But we think that concern is overblown for one important reason. Most of that debt is issued by government enterprises to other government enterprises. The largest debtor are local governments, and the second largest debtor, and most of the corporate debt, really sits in state-owned enterprises. So basically what you have is the debtor and the creditor are the same. That debt is not going to default. Now, the real question is, why is it in the banking system? And the answer to that is pretty simple. It's in the banking system because China does not have a capital market. If the US Treasury runs a deficit, it can sell you a Treasury bill. China can't. It doesn't have capital markets. So it sits in the banks. Now, what we think will happen as time goes on is we'll start to see a lot of that local government debt turn into bonds. And Westerners will buy those bonds. And they'll buy those bonds for two important reasons. One, they'll be backstopped by the government. After all, it's government debt, much like US Treasury debt. And the second reason is they'll have pretty good interest rates. They'll have interest rates that will range between 3 and 5%. And when most Western government bonds yield 0 to 2, that's a pretty attractive interest rate, particularly if it's backstopped. So again, we think the concerns over debt are overblown, and we think most of that debt will be reformed in a way that doesn't hurt the economy over the next several years. What seemed to set off the decline in Shanghai was the decision by MSCI, which creates the global equity market benchmarks, to delay including the Chinese domestic markets in their indices. This happened a few weeks ago. We're not surprised. And you have to realize it's a delay, not any kind of a permanent injunction. And the reason they delayed is China still has to free the renminbi, and it has to open up its capital markets. Had they put the domestic markets in those indices, they'd be benchmarking investors against an index that they couldn't buy because of those capital restrictions. What we think investors will be surprised by is how quickly those impediments are removed. We're already beginning to see events move in that direction. The Shanghai-Hong Kong through train, whereby investors in Hong Kong can buy stocks in Shanghai and vice versa, has been very successful, and it'll soon be joined by other through trains, one in Taiwan and the second in Singapore. And the second is, as I mentioned earlier, you'll start to see local governments issue bonds, and that will make the local bond market in China much, much more liquid, again, with very attractive interest rates. So these are all moves to kind of free up capital moving in and out of China. The real issue is, when does the renminbi, the local currency, become totally convertible? And we think that'll happen in a very short period of time. You've got an example of that. Right now, over 1/3 of China's export trade with the rest of Asia is in renminbi. That number was 7% in 2012. So even though MSCI momentarily delayed the inclusion of domestic Chinese markets in their indices, that will change fairly rapidly. Now, what does it mean? Well, right now, China, because most of the stocks that are in global indices are just Hong Kong listed stocks. That's 1.7% of the major market indices. Japan's 10%. China's economy is 15% of the global economy. So as China gradually becomes part of the global indices, the need for non-US or non-Chinese investors to buy Chinese stocks, just simply to represent the benchmark, will be huge. China is going to be under an awful lot of pressure to internationalize its capital markets and to free the movement of capital in and out of China. China never does anything that's not in its best interest, and it is in its best interest to open up its economy. Several reasons, the most important of which is China right now has 100 million retirees. By 2040, it will have 300 million retirees. So those are folks that will be in need of some retirement income, and the capital markets essentially have to provide that. It is totally unequipped to deal with that today. The second is to really generate the income and the investment capital that's necessary to really fill out the rest of the infrastructure investment, and particularly to build the through train to the rest of Europe and Africa, is going to need an awful lot of capital. So China needs capital. Now, this might sound a little cynical, but it's very real. The best way to generate that capital is to sell their ownership in the state-owned enterprises to the global financial community. And the best way to do that is to get their stock market indices in the global indices, because every exchange-traded fund in the world is going to have to buy these stocks. So it's a way of opening up China to international capital, both in terms of offloading the SOEs, but more importantly, to free capital movement to the private sector. If China can open up its private sector to foreign capital, it'll be huge. It'll be a major source of investment capital and really set off an investment capital boom in China. So that's really the heart of the long-term China story. The obvious question is, how long will this take? And I think the answer is it'll take a remarkably short period of time, because it's so much in China's interest to do this. So that's why I think the Hong Kong-Shanghai through train, the expansion of that, the sales of government SOE bonds into the private market, and thirdly, just the internationalization of the renminbi will happen very rapidly. And the best way to watch it is just watch the news events that come from China. But I think it'll happen a lot more rapidly than most people are thinking right now. China's slowing is probably a very bullish event for stocks. And the best example would be the other Asian tigers. When you look at economies and stock markets like Taiwan and South Korea, when those economies grew double-digit rates, as China has been doing until recently, their stock markets were very moribund. They were dead in the water, and the reason was those were investment-driven. Most investment was government-driven investment. Productivity was very low. A lot of capital was destroyed, and even though the economy grew, productivity didn't. So the markets didn't do anything. Once the economy slowed, and they slowed because government investment slowed, but private investment picked up the slack, productivity rose, and that's when those tiger markets were really very, very strong. Some of them went up 10 times. So I think China is probably where Taiwan and Korea and South Korea were back in the early 1980s. And of course, as you remember, that decade was the decade of the Asian tigers. Shanghai's getting all the press, even though very few of us have any money invested in Shanghai. You have to realize Shanghai is, right now, it's a domestic market. It won't be in 3 to 5 years, but right now, it's a market that's populated by domestic Chinese investors. And domestic Chinese investors tend to follow momentum. They're not as sophisticated as most institutional investors, who really look for reversion to mean over time. So if a market gets overextended, we'll make a judgment that it'll revert back to a mean, and that's the source of our investment strategies. In the case of domestic Chinese investors, they'll just follow it until it stops. So that's kind of what we're seeing. That's why the internationalization of these markets is very important. But the real question is it masking something? And we think it is. If you look at the values across various Chinese markets, right now Hong Kong sells for about 11 times earnings. The Hong Kong China Index sells for about 9 times earnings. Even in Shanghai, most of the middle size and larger capitalization stocks sell somewhere in the teens. Now, it's when you get to the very small stocks, the more speculative stocks, that you get those high PE ratios that folks talk about. Right now, if you looked at the small stock exchange in Shanghai, it's selling somewhere between 55 and 70 times earnings. And if you remove the banks, it's selling at 90 times earnings. Those are obviously not stocks that a prudent institutional investor would buy. But that masks an awful lot of values of very, very strong companies with strong franchises that sometimes are global enterprises that are selling at much more modest PEs. Obviously, the volatility that we've seen in Chinese markets, particularly the A-shares in Shanghai, are upsetting a number of investors, and that's understandable. But you have to realize Shanghai is an undeveloped market. It's there only for domestic investors. Domestic investors in China particularly, in an economy where capital markets are just evolving, tend to be very unsophisticated, and they tend to be momentum players. As institutions, the rest of us have a much more of a fiduciary approach to capital markets, and we tend to look for reversion to the mean. If a market gets extended on one side, we'll tend to make a judgment that it'll revert back to some sort of normalcy, and that's an investment opportunity. Well, the domestic Chinese individual investors don't think like that. They're momentum players, and they'll follow that momentum until it burns out. That will change as Shanghai becomes more international and it becomes more rational. There's more capital migration to it. But in the meantime, some of the PE estimates that I see really aren't very reflective of what the Chinese markets are right now. They're really astonishingly cheap. If you look at the Hong Kong index, it sells at about 11 times earnings. The Hong Kong China index sells at 9 times earnings. Even the Shanghai market, if you leave out the smaller stocks, it sells at maybe 15 or 16 times earnings. Now, if you look at the small stocks in China, in Shanghai, where most of the speculation is, they sell at 55 times earnings, and if you remove the banks from that number, they sell at 90 times earnings. So that's really the source of the high multiples that you see reflected from time to time. There are an awful lot of values in China. Now, the real question is, what would continue that bull market in China? And we think there are really 2 sources of liquidity. First of all, like anything else, as people become richer, as incomes continue to grow, they do more things with that income. You get to $1,000 of income, you buy a cell phone. You get to $10,000 of income, you buy an automobile. And just to look at automobiles, we've gone from 2 million cars to 20 million cars in 15 years as more and more people reach middle class. You eventually get to the point where you have to invest your savings, and that's where we are in China today. More and more Chinese will be investing. Right now, from what we can calculate, maybe 4 or 5% of Chinese actually are invested in the capital markets, particularly in stocks. That number is 50% in the United States, and they've got 4 times the population. So there's no end to Chinese demand for investment product as things evolve over the next few years. The other thing that you keep in mind is China still has a 4% lending rate and a 2% deposit rate. Those interest rates will come down as China continues to emerge into a developed economy, and that's another source of demand for stocks. So we're not concerned that there's a lack of domestic liquidity. We just want to see that liquidity become internationalized. And as it does, China will continue to be one of the best, if not the best, performing market in the world. If you're going to invest in any emerging market, you have to go in with your eyes open. And as you know, understanding that, we built a research office in Hong Kong with 3 highly competent people who have been investing in Hong Kong, probably a cumulative total of 60 to 70 years. The second issue is, how do we know the numbers are right? And the answer is, well, you see what's going on at the company level. We have 3 people, as we said, knocking on company doors day after day. And we know the managements very well, and as a result, we have a lot of confidence that the numbers that we invest in, the companies we invest in, those numbers are good. And what's remarkable is how fast these companies are growing. There's a strong feeling China's economy is slowing, and it is, but it's still growing very rapidly, and we can see that at the company level. The third point I'd make is you have to realize most of our investments are in Hong Kong. And Hong Kong probably, well, the Hong Kong Securities and Futures Exchange has the toughest compliance on the global stage. And the reason it does is if that market were tainted with any corruptive enterprise at all, that city-state would lose its virtual reality for being. So our sense is that we've got a very, very strong regulatory environment. There have been very few companies that have displayed the very bad corporate governance that we've seen in Chinese companies that are listed in the U.S. And we're pretty confident that we know what's going on there.